All right, John, can you hear me okay?
I can. Can you hear me all right?
I can. We are
Perfect.
just getting everything put together here. I just want to welcome everyone into the room and thank you for joining us this afternoon. We'll be going live with John Carter in just a minute. Yep. John, you can hear me okay?
Loud and clear.
Excellent. All right. Well, we're delighted to welcome our next presenter to the stage. John Carter, president of Simpler Trading, has been a full-time trader since 1996 and has actively traded for the past 25 years. Grew up the son of a Morgan Stanley stockbroker and was introduced to option trading as a sophomore in high school. Mr. Carter launched simplertrading.com to post his trading ideas. Today, he has following more than 50,000 people. Mr. Carter publishes a free daily as well as a premium newsletter that discusses specific trade setups in the financial markets, as well as commentary on the overall economic outlook. John, the stage is yours.
Awesome. Thank you so much. We were just commenting just how the pros and cons of COVID, but one of the big pros is just everybody just kind of moving online with ease. It's just, especially from a trading perspective, it's so much easier. So, hey, everybody, welcome and happy New Year. Let's just really dive in here. This is just kind of 2020 was a fairly amazing year. And what we want to look at is what kind of things we have in store for 2020, and just the idea that we can take advantage of really whatever market conditions come to us. And I think that in trading, there's always kind of that, you know, trying to catch the big move and, trying to catch that life-changing move in like a Tesla, or a Bitcoin, which is nice, don't get me wrong, but you can actually make a lot of money not catching any huge moves like that. And so that's what I want to really talk about, just in terms of taking advantage of the volatility and stuff like that. Now, if you're newer to trading, the typical path is something like, I'm gonna watch a webinar and I'm gonna read a couple of books, and life is gonna be very simple. The reality of trading is like this, and I've been doing this for, gosh, I think it's 28 years now, and this is how I started. And then I had this kind of you know period of time, let's call this 8 years, where I'd make some money and I'd lose it, and I'd make some money and I'd lose it and make some money, and then had this total disaster. And then finally, it's just like, what? I just want to get a little bit more consistent, and and just have an equity curve that goes from the lower left of my screen to the upper right, and that's it. That's really my only goal as a trader. And by realizing that, it really I was able to let go of a lot of the, I don't know, problems that traders have, or at least I had, in terms of, I can't take this loss because it'll make me a loser, or I got to hold on, well, whatever all that crap is, which doesn't serve us. So last year, again, I always like to just kind of show real accounts and stuff like that. So last year, I started this account with $1.4 million. I wired money out, but I ended the year making $16.5 million. So it was like a 1,188% return. It was fantastic. This was on December 31st. And then I wired money out, obviously, for taxes, and then to put into things like real estate and stuff like that. And then this year I'm starting off with just under 5. And I just want to see what I can do. And what I'm going to be doing is basically the same strategies that I'm going to be talking about here. So, really what I've found in trading that works is ultimately it's patience. And one of my mentors, her name was Mary Ellen, and she told me, John, there's no trader that's born with the patience gene. And if you can't learn patience, you're not going to do this, because basically trading is about the patient taking money from the impatient. And that always resonated with me. And what that means is that it's better to have, let's call it 2 well thought out, well planned trades per week than trying to jump on every little thing that's moving. And I think that's just I think the longer you trade, the more you realize that you just don't need to be in everything, and it's okay. So what I found is that without a plan, what happens is that the brain takes over, and the brain is not wired naturally for the markets. So a very common thing that'll happen in trading is, someone gets into a trade, they start to get excited, and then once they get euphoria, which truly is just dopamine, which is just a dopamine release. And by the way, dopamine is an addictive feeling, and people drink alcohol, they do drugs, they do all kinds of things chasing that dopamine high, and in trading it's no different. And so a lot of times what will happen is there's a trade that's taking off, and when we see that trade taking off, our brain will release dopamine, because we imagine all the money we would make had we been in it. And then we confuse that dopamine, that good feeling, with, oh my gosh, I should get into this. All right. And that's what causes a lot of people to buy at the highs on euphoria. And then on a normal pullback, maybe back to the 21 period moving average, they capitulate and they get out, and it's this horrible thing. Yet there's somebody on the other side of that cycle that's picking that up. So, and that's what we want to talk about. So if you can't get on that cycle, basically your trading journey is very short. It's either you blow out your account and you're out of money, or you blow out your account and you got to put in more money. And it's a cycle that will continue until you figure that out. And so what I want to talk about today is a technical setup, which is just looking for what's called a greater than expected move. Okay. Markets basically just kind of trade in a range almost all the time, and once in a while they pop up. Now, are there exceptions to that? Of course, Tesla has had a greater than expected move almost, every week for the last 2 years. But 95% of stocks trade within a very consistent range. Now, what's nice about this range is that it's already calculated in advance. So this happens to be Home Depot. It doesn't matter what stock you're looking at. This happens to be Thinkorswim. Whatever platform you're using, it doesn't really matter. But basically what happens is that the options price in what's called the expected move. So in this case, Home Depot, with options 7 days out, the options are priced for an expected move of plus or minus $3, okay? And then 14 days out, the options are priced for an expected move of plus or minus $4.30. If you were to go out 35 days, you got an expected move of plus or minus $7.30. So not only are the options priced for that move, but like 70% of the time, sometimes more, the stock actually stays in that range. Sometimes it'll pop up through it or pop down through it, but it closes within that range. And this also has to do with all the open interest in the options and stuff like that too. It kind of keeps things contained. So this being said, is that most of the time, if you aren't aware of this, it works against you. You might be buying a call, the stock doesn't do what you thought it would, and you lose money. And so what we want to do is we want to identify those moments in time where there's a greater than expected move. Okay. So an expected move basically just looks like this. You remember the range was like $3 or $3 or $4. Here's Home Depot just staying in a $3 or $4 range. Guess what? It's staying within its expected move. So, if you chase this and you buy calls hoping it's going to explode, you're going to be disappointed and you're going to lose, probably all the money, especially if you buy an out of the money call on that. But instead, if we wait for a specific signal that gives us an edge, that's telling us there's a higher probability here of a greater than expected move for a short time, that's where we can actually really kind of clean up on some various option strategies. All right, so what is this? All this is it's a relationship between the Bollinger Bands, which are here in red, and the Keltner channels, which are here in blue. The Bollinger Bands measure what's known as a 2 standard deviation move. The Keltner channels, which are blue, measure what's known as the average true range. And so what we're looking for is periods of time where the markets are getting really quiet. And so then the question is, well, okay, well, how do you define quiet? How quiet is quiet? And I define quiet is to the point of when the Keltner channels, when the Bollinger Bands, you can see here how wide they are, they contract to the point that they're trading inside of the Keltner channels. So another way of saying that is that the market gets so quiet that the 2 standard deviation move has actually contracted to the point where it's trading inside of the stock's average true range. You don't need to know any of that, but that's just what it is. But when that happens, then it's basically built up a lot of energy and it needs to release that energy. Okay. And then from there, when that happens, if I look at the momentum and the momentum is turning higher, basically then it's like an 85% probability that when it does release that energy, it's going to be to the upside. Okay. And of course, if the momentum's going lower, below zero, we would actually look for a short trade. So how this looks on a chart is we took a tool and we just call it the squeeze. And when there are red dots, like right here, and right here, that's just an indication that this is a high probability moment in time where the Bollinger Bands are trading inside of the Keltner channels, okay? So for me personally, I don't care if I'm trading Home Depot, if I'm trading Tesla, if I'm trading Amazon or Facebook or Peloton. What I'm looking for are squeezes. And if the squeeze happens to be on Peloton, great. If it happens to be on Pinterest, great. But I don't care about the stock. I care about that high probability moment in time that's going to give me an edge, okay? So if you guys have Thinkorswim, you can just go onto the platform. You'll see John Carter's studies and it's on there. And I believe now it's officially on Tastyworks as well. So those are some platforms that have it. And if you don't have those platforms, I think we have it at our site where you can get it and download it. So here's a good example of how this works. So chop, chop, we're in a range, we're in a range, we're in a range. Here's a squeeze. The squeeze gives us a heads up that there is a greater than expected move coming up. And remember, in this case, the expected move was like $3 or $4. Boom. Instead of a $3 or $4 move, we have a $15 to $20 move. Okay. So imagine in this situation that you buy calls, right? And you're going to make a lot of money on that versus if you buy calls, like say at the top of this range here, and we're still stuck in this range. All right. So that's all there's one setup I could do the rest of my life. That's it right there. And it doesn't matter if you do it on a daily chart or an hourly chart. A daily chart, basically the signal lasts 8 to 10 bars. So on a daily chart, it's an 8 to 10 day signal. On a 1 minute chart, it's an 8 to 10 minute signal. I don't do this on 30 minutes or less, unless it's a special situation. I've done 5-minute squeezes on really high volatile stocks like Tesla. But other than that, so now we got the signal, but then the question is, like, I'm a huge fan of trading options. So once you get the signal, what do you do? And I always like this because it took me a long time to learn this, but just because the option is cheap doesn't mean that the option is profitable. And this is just a way of saying, don't buy those cheap out of the money options. I'm not saying you can't ever do it, but if you're going to put the odds in your favor, I would rather you buy one expensive in the money option versus 10 cheap out of the money options. The out of the money options are designed to expire worthless. The in the money options have some intrinsic value. And when the stock goes up, it's going to go up as well. So I always say, watch your delta. If you're familiar with the term of delta, basically, what that means is that if the stock moves $1, that's what your option is going to move. So if you buy an out of the money Delta 30 option, it's only going to move 30 cents if your stock moves $1. Now, don't get me wrong. If the stock moves $100 like Tesla, your Delta 30 option is going to make a lot of money. But on a normal stock like Home Depot, if you buy a Delta 30 option, you're going to be lucky, frankly, if you make any money on it. Yes, if you catch one of those greater than expected moves perfectly, you will. But why not put the odds in your favor right from the get-go? So what I like to do is go in the money, and I'll get a Delta 70 option. Okay, so basically, if the stock moves $1, I'm going to get 70 cents, all right, on my option for every dollar. So yeah, I'm not going to buy as many, but the odds are in my favor of basically making more money. And then I also like to sell options as well. So if I'm going to buy Delta 70, then if it's a Delta 50 or less, I'll sell it. All right. So I always say a picture is worth 1,000 words. So let's just look at a setup. So this is a setup I did on Netflix on, I don't know if it was, what's today, Wednesday? I think I did it on Monday. So on the daily chart, we had a squeeze. So I've been keeping an eye on this. Okay. And these are just 3 sets of Keltner channels here. So I've got 1 average true range, 2 average true range, and 3 average true range. And generally what I'm looking for is if I get a squeeze, I'm looking for a move from that 21 period moving average. If it's on the upside, I'm looking for 2 ATR. If it's on the downside, I'm looking for 2 ATR to the downside. So we had a squeeze here on Netflix on the daily chart, but we also had an hourly squeeze. All right. And so when this hourly squeeze was setting up, I bought Delta 70 puts, but then I also sold some call credit spreads. All right. So what does this look like? So here's Netflix yesterday. It's down, $6.20. So I bought the in the money Delta 520 puts. So I bought these at, $19.64. And as of this screenshot, it was at $28.45. This was right before it hit my target. And so that was a good trade. Fairly solid trade there. But on the other hand, what I also did is I sold at the time the Delta 40 call and did it as a spread. So I sold that for $7.70 and then bought it back for about $3.70. So what I like to do is, again, if I'm going to buy a directional option, whether it's a put or a call, I'm going to go in the money. But then at the same time, I like to sell either, call credit spreads if it's a bearish trade, because the calls lose money if the stock goes down, or put credit spreads if it's a bullish trade, because that also gives me a little bit of edge because I'm collecting premium during that. And you can actually structure this where typically you've got to do about 3 times as many spreads as long calls, but you can actually make that theta positive. And all that means is that when the stock is going sideways and you're waiting, you're getting paid to wait, because the premium decay, instead of leaving your account, like if you just had long calls, is coming to you. All right. And that's, and over time that adds up. I mean, that gives you an edge. So here's some examples of some trades. So, and the squeeze works on anything that moves, basically, that you can chart. So this was gold. So this was a weekly chart of gold back when it was, kind of working its way up to 2000. We had this huge squeeze. If you guys remember, I think gold went to like 2060 or something like that, and it had a huge pop. So even though I'm not a huge fan of trading gold futures, I will trade them, but they're kind of scary. I will chart it on gold futures, and then I'll just go ahead and buy calls on the ETF. So in this case, I got the in the money, again, Delta 70, 170 calls, and then I sold, I bought a call debit spread. So, and again, if you're newer to options and you're not familiar with some of these terms, don't worry about it. The easiest thing is that if you think gold's going up because you have a signal, you just buy some calls, buy some in the money calls. I bought these for 12. At this case, they're currently, they were currently $17.80. So and it's just like, it's like buying a stock at $12 and then selling it at $17. And then in this case, what I did is I bought a slightly out of the money call, right, which I said not to do, but then I sold a call against it. Okay. And I don't mind doing that, because then the premium decay in this out of the money call helps offset the premium decay there. All right. So I don't mind doing that at all. This is the SPX. So another way to do this was a daily chart of the S&P 500. We had a squeeze as it's getting ready to go. And it's like, okay, well, how do we do this? And again, you can buy a call if you want. What I found a lot of times is that the premium on the indexes is pretty high, and I would rather just sell a put spread. So put spreads, when I first started trading, credit spreads to me were so boring. I was like, why would anybody do a spread? If it's going to go, make a directional bet. And as I've gotten older and wiser, I found that, maybe instead of buying 50 calls, I'll sell 200 spreads, because I'm going to make about the same amount of money if the trade works out. But if for some reason, the S&Ps trade sideways, I'm still going to make money on the spread, but I would have lost money on the call. And over time, that edge really helps your balance climb over time. This is PayPal. So again, what we're looking for here is, it's like, all right, do we have a squeeze? Yes, we do. How do we construct it? And so in this case, I went ahead and sold some puts, a put credit spread, and then I sold some naked puts as well. Now, and you can see I sold these naked puts for like $1.86. Now they're 7 cents. So I'm basically keeping all that premium. Now, if you're newer to trading or you've got a smaller account, I'm not the first one. I'm always saying, like, look, you don't need to take unnecessary risks. So I don't necessarily say that, if you've got a small account or you're newer, that you should sell naked options. If you are going to sell naked options, always err on the side of puts. If you sell naked calls, lots of bad things can happen. You guys have seen Tesla go up, $200 in a week. I have friends that got destroyed selling naked calls on Tesla. You just don't want to do that. Or a company gets bought out. If you were short naked calls on Slack and then it gets bought out by Salesforce, you're screwed. You can always do a spread though. So just don't, instead of, just as a rule of thumb, there's no reason to set yourself up for a disaster in trading, right? Just do a spread, live to fight another day. Now, I talked about that generally I don't like doing like 5-minute squeezes. I will make an exception for a crazy stock like Tesla. So this is a 5-minute squeeze, but way back when Tesla was at 1,420, and you can see it just took off here. And with this particular trade, we did, I did a bunch of calls, call debit spreads, different things like that. And, it turned into $1 million day on that one. So, you can get some crazy stuff there. Another way to do this, so here's crowd, CRWD. This is an intraday chart. You get the squeeze. One thing I haven't mentioned here is that, you can buy stock too. And stock is once, if you've done options, you really appreciate stock. The only downside of stock, of course, is that it takes up more buying power. But if you've got the buying power, basically you're getting a Delta 1 option with no expiration. So I kind of like that. And in this case too, I also sold the put credit spread. So the 85 put, bought the 80, had a $2.35 credit. And you can see at this point, as it drops, that's good because you're short. So if you short something and you buy it back at a lower price, you keep the difference. So it's the same thing if you short an option spread, you want to buy it back at a cheaper price and you keep the difference. So it's kind of a nice thing there. So a couple of setups that are happening right now. In fact, this is a trade that I'm in right now, Match.com. Okay, nothing special with the stock. It's just that it's got a squeeze. Got a little, this is called an RAF buy signal here. Great. And what I love is that these moving averages that I like to watch are also what I call stacked positive. Okay, so these are basically it's the 8, the 21, the 34, the 55, and the 89. And they're all Fibonacci sequencing numbers. It's just, you can use 10, 20, 50. These are just what I like to use. The little skinny one here, that's the 5. I keep an eye on that one as well. Basically, in a strong market, you're not going to breach that. The strong trend is not going to breach the 8. And if I see a squeeze and the moving averages are stacked positive and prices generally above the 21 like that, the odds of it going higher once the squeeze is released is like 85, 90%. Okay, and that's what's happening with Match.com. So there's not a lot when a setup like that happens. So a lot of times people say, oh, what do you think of Tesla right here? Does it look like this? If it does, I want to buy it. If it doesn't, I don't care. So that's what I'm looking for is the setup. Another one is Pinterest. This is one that we also picked up. Same thing. You got to squeeze. The moving averages are stacked positive. That's what I'm looking for. That's what I'm looking for a high probability moment in time. Notice how right here, Pinterest chopped sideways. So anybody that was buying calls was getting chewed up. Okay, then it's going into a squeeze, right? And then we're looking for it to release that energy. So for Pinterest, same thing, my same drill here is I went ahead and bought some deep in the money calls 37 days out. Okay, now even though I may only be in this trade for 6 to 8 days, by going out 37 days, I'm minimizing the premium decay. So sometimes people will say, well, I'm going to go ahead and buy the calls, but they're going to expire in 2 days. The problem with that is that if you have one bad day, the stock goes against you, you're kind of screwed. But if you've got 37 days, you have time, you don't, basically if you get an option that's 2 or 3 days out, if it doesn't take off, you're screwed. So if you're 30 days out, not only are you minimizing the premium decay, but since you don't know exactly when it's going to go, you're able to sit there on it. So I'm always saying, when in doubt, if you're going long options, when in doubt, give yourself the gift of time. If you're going short options, totally fine to go closer in. Take advantage of that premium decay. The other thing I like to do here is called a diagonal. So in this case, I bought the $65 call, which is in the money, 37 days out. And then I sold the $80 call against it. Now I'm losing money against that, but that's okay. That's a good problem. If Pinterest in 9 days at $80, I'm still going to make plenty of money on the long calls. In a perfect world, what happens is that in 9 days, Pinterest closes at $78. This call expires worthless. I keep the money and then I continue holding the long calls for more. And so that's something that I like quite a bit as well. So the usual questions that I get here, and by the way, I'm going to open this up for questions in about a minute. How long does the squeeze last? And it's 8 to 10 bars. So after it fires, which is the first green dot after that series of red dots, you're looking for 8 to 10 bars. So a daily chart, that's 8 to 10 days. An hourly chart, 8 to 10 hours, etc. How can I tell if it's going to fire long or short? So I was just talking about that with the moving averages. If the moving averages are stacked positive like that and prices above the 21, the expectation is that's going to fire long. If the moving averages are stacked negative, but more than likely if they're mixed, if the 21's below the 55 and it's a mess and there's a squeeze, at that point, you're looking for a down move. So what I found is in trading is that a bullish move needs to be about perfect because it takes a lot of power to move a stock higher. But a short trade can be sloppy. It could be a sloppy long because all you need for a stock to fall is a lack of buyers. So it's kind of nice that way. And then when do you get in? I wait till after 5 dots. So after 5 dots, if the moving averages are stacked positive, prices above the 21, I'm in, and you can scale in, that's fine too. And the one thing here is that market makers do not take into account the squeeze. So they do not adjust the price of the options with the idea that there might be a greater than expected move. That's the whole reason this works so well with options. Which is great. And a lot of people ask, can you use this for Bitcoin? The answer is yes. Here's a squeeze on Bitcoin, pop, squeeze on Bitcoin, pop. I think the current move in Bitcoin is done. It needs to catch its breath, and we wait for the next squeeze. All right. And then at the end of the day, as a trader, everybody thinks like, oh, I got to make money. I got to make money. Truly, your only job as a trader is killing trades that are not working. Okay. And once you get your arms wrapped around the idea that that's your only job, it makes trading a lot easier, and it makes taking losses less stressful. Okay. So that's what we got. I'm happy to answer questions. If you guys want a copy of this presentation, just go to simplertrading.com/John. And you'll get a copy of it. And then, yeah, I'm happy to stick around here and answer questions until you guys kick me off.
Hey, John.
I know we got a schedule.
Thanks so much. Can you hear me okay?
I can.
Excellent presentation. I know our audience really appreciated. Let's jump into our first question. One of our viewers write in, if you sell a naked put, don't you have to lock up the capital to have money to buy the stock to fulfill the put? Is there a way around locking up the capital?
So it depends on your account type. If you've got a larger account, you can do what's called portfolio margin. Unfortunately, that takes, it's an account size of you typically over $125,000. And in that case, you don't have to put up the money for the stock. But I think in a regular margin account too. So if you have a cash account, then yes, you're going to have to put up all the money for the stock. If you get a margin account, you don't have to. But a tip for you is that if you sell, let's just say, Pinterest, let's say that you sell the $70 put naked, just buy a cheap out of the money, buy the cheap $50 put and offset it. So you can create a wide spread, which is, pretty close to selling it naked anyway, but then you reduce that margin requirement quite a bit. And so I do that a lot just to reduce that, pressure that, the money that they lock up for that.
Thank you. Our next viewer writes in, if your broker only has them at an option level 0, they're a newbie saying, do you suggest just doing the buying covered calls on the squeeze, or do you have something else you recommend?
Well, so what I would do is, if you can, I would ask for more permissions. And so the thing is, the brokers just have to check the right boxes. If you've taken some classes, that's kind of the equivalent of 3 to 5 years experience. And you can kind of go back and say, hey, I've got 3 to 5 years of experience, and then they'll open it up. That's one thing I've found that it allows you to do more that way. The other thing is for what you're asking, it is completely fine to do covered calls as well. What I would do on something like this with the squeeze, if you own the stock and you want to do a covered call, you let the squeeze fire, and then like 5 or 6 bars into it, sell those covered calls, because at that point, you're looking for it to kind of to end and roll back over a little bit.
Thank you. Do you do anything with UVXY options or spreads? The viewer writes in, seems volatility keeps going down. What do you think about options trading around the VIX?
So on options trading around the VIX, I'm not a huge fan of it. I mean, there's definitely some advantages to it. And what I do is that if it looks like the market is going to puke, right? Or I've got some concerns around the market, I'll buy some VIX calls as a hedge. But in general, I kind of stay away from it. I personally, my trading style works good with, the Facebooks and Amazons of the world. But if I'm concerned that, I've got a lot of long exposure and I'm concerned the markets are going to puke, I'll buy some VIX calls. But I don't do a lot of what I would, call it advanced trading around the VIX or the UVXY.
Excellent, thank you. One of our viewers write in, and I guess this was brought up a few times, but they say, when I compared your sample graphs with my thinkorswim charts, the squeeze, red, black setup dots were the same. Do your charts have different settings than thinkorswim?
So well, there's two kinds of squeezes. So there's the default squeeze, which is on Thinkorswim, and then like last year we developed what's called a Squeeze Pro, and that just gives you a little bit more signals. And you'll see some of the black dots too. But the regular squeeze that's on Thinkorswim, you can use that one by itself. It's fine. It's just that the Squeeze Pro has additional signals that pop up in there. So I think that if that answers your question,
Yep.
if I understood that correctly.
Yep, thank you very much. Are the moving averages more important than the momentum and the direction for the squeeze?
Oh gosh, okay, good question. So, yeah, in my opinion, if the moving averages aren't stacked positive, and if everything else is perfect but the moving averages aren't stacked positive, I'll go look for a different setup. So a good example I think was the names escape me. Is it the TV one, the Roku? I think it's Fubo or something like that. But it's got like a squeeze and it's turning, but man, it's come down so hard, so far that the moving averages are messed up. And so I see something like that, I frankly just move on to a cleaner setup. And so sometimes I miss out on some of the high flyers because I just, I want to see those stacked moving averages.
Excellent, thank you. How close to maturity do you look to close positions?
Okay, so I do not like holding on to options until the last minute. What I've found in trading is that there's a saying that we have, don't lose your ass on a Friday. And if there's something that's going to go wrong, it's going to go on a Friday, especially if your options expire that day. So if I've got options that say expire this week and I'm long, I generally want to be out by like Wednesday. At the just give yourself more time and roll it out. So yeah, I'm a huge fan of make your money and get out, and don't wait till the last minute.
Excellent. All right, one last question. What is your biggest lesson for new traders that you've learned over the years, whether it's focused on setting stop losses or just in education in general? What would you leave the audience with in terms of your biggest lesson for new traders?
But the biggest lesson I would say is just take a deep breath. The market's not going anywhere. Trading is a skill. Don't you just want to. If you think of, you always hear about the magic of compound interest, right? And it's just like, if your account compounds at 5% a year, in 70 years, you're going to be a millionaire. Well, I don't know about you guys, but 70 years is a long time. So if you think of trading of like the ability to compound your account at say 5% a month, okay, and if you're trading options, that's not unreasonable. Well, you don't have to take a lot of risk for that. You can sell a put credit spread and still have 90% of your account in cash, and that put credit spread can help you meet that goal. So I would just say that you do not need to take a lot of risk. If you've got any positions that are stressing you out, cut them down, but just trade small, grind it out, and develop your skills. And as you develop your skills, other opportunities will come to you. But I think that's the biggest thing. Just relax and have patience. And this is trading. I've been doing this a long time, and the markets are still going to throw me curveballs, but you just got to, you take the punches, you close it out. Learning to close out losing trades without any shame or regret is one of the best things you can do, and just move on. The market has nothing personal against you. It's just doing what it's doing.
Excellent, John. Well, we really appreciate your time today. Thank you for joining us. I know our audience appreciated it as well. And we'll hope to see you at a money show, maybe in person later on in 2021.
Yeah, sounds good. Or 2025, right?
Right, exactly. Thank you very much.
Yeah, have a good one, everybody.
Thank you. And just a friendly reminder to the audience, you can replay this session and every session from the event by visiting virtualpass.moneyshow.com. Thank you for attending.